Hello everyone, welcome back to the channel, best place for long-term stock investors. Now, in today's video, the US have actually announced their latest CPI report, and it is actually down almost like more than 1%. It's like now 7.7%. So the market definitely loved it.
Yeah.
It rallied a ton, and we're gonna see whether is this sustainable. So stay tuned. Now, as a disclaimer, none of what we say should be taken as financial advice. If you need that sort of advice, please speak to a professional.
Hey guys, before we begin, just to let you know, we have a totally free masterclass just for you to sign up for in the comment section or the description, where we will guide you on how you can build a 6 to 7 figure portfolio using the power of stock investing. Go check it out.
Okay, MJ.
Yo.
So the US inflation rate is actually now about 7.75%, which is actually down from its last month, which is around like 8.2%.
Okay.
And if you notice that the market is actually rallying, I mean, they love it when inflations are down. But will this continue to lower, or will it like stabilize around 7 to 8%?
It's always hard to say, but the signs are showing that it will lower. But you never know, because inflation, as far as an investor, you need to be aware that CPI, which is the measure of inflation, consists of many different components. And so even if inflation drops, it doesn't mean that, let's say, energy will drop or housing will drop. But of course, likely if there's a drop in CPI, it was caused by a combination of food, housing, healthcare, things like that. But it's important, I think, people to know this concept of demand pull inflation. So when it comes to inflation, there's actually three broad causes. So one is demand pull inflation. So this is if people demand a lot. There's a lot of spending power. There's a huge consumption boom. Then, of course, if supply stays constant, and every Econs 101 grad will know, then prices will rise. Similarly, in the reverse is what we call a cost push, or a supply-based kind of inflation. So, if cost goes up, things like that will affect. And if demand stays the same, well, then price starts to drop in terms of supply dropping as well. So many ways to look at it. Another way is expectations. So if people expect that the future is not going to be so good, so they will likely spend less, and that's when inflation starts to drop. A bit complicated, but that's essentially how it is. Now, the chart up here essentially describing the top four central banks, especially as far as their balance sheet is concerned. Long story short, this is essentially like how much liquidity they want to pump into the system. And this is also a contributing factor to demand. So if there's less liquid money in the system, there's less, ability to consume more or anything.
Yeah.
Right. So you can see right now it's still, it's dropping, but all these are just estimates, right? From here to here. So we can anticipate the CPI to drop as a result of this.
Oh, this relationship is quite confusing, right? Because like there's certain periods they are inverse in relationship. Like you can see like in 2012, then you can see over here 2016 also inverse. But here is much more like a direct relationship.
Which is very interesting, right? Who knows? But as far as before 2020 is concerned, right? A lot of this is a function of time lag.
Right.
So if people start to, let's say if the central bank starts to reduce the balance sheet, the effects only comes in a bit later, because CPI is essentially what we call a lagging indicator. It's, it's an effect, right? Of people's or the bank's activity. And also remember that this period, right, is a period of, it's very unique, right? It's a pandemic plus very aggressive rate hikes. So we'll see.
Okay. And actually, I've read some of the comments, right?
Yeah.
That some of the US consumers, or basically the people in the US in general, basically they don't really feel the effect that the inflation is trickling down. So why is that?
Well, I'll show later on in the charts, but essentially, inflation is a combination of many components, as I said, and one of them is actually food. Now, one thing we know for a fact is that food is not exactly declining as far as price goes. But just to answer your first question, right?
Yep.
If you can look at some of these indices or charts, you can see the commodity index is also not growing already. So again, energy prices are falling. And in fact, in our FIRL Pro course, we had already been predicting this about 3 months ago, 1 quarter ago, right, roughly. Because we not only measure things like oil and gas, we also look at things like lumber, which is a proxy to housing demand, right? And lumber is actually dropping, like, I think
it was crashing up.
Yeah, it's more than oil and gas, right? So we know if housing drops, right, so a lot of other raw materials are likely to drop as well, whether it's copper, iron, and all that. So then when you look at the commodity index by Bloomberg, you see the exact same thing. Another thing is the supply. So I actually didn't know this. There was actually a global supply chain pressure index. So of course, the closer it is to, zero is the best.
Yep.
And if it goes up, the pressure is high. So it's actually dropping quite a bit, quite fast. And all of this will be a leading indicators for inflation. Because as I'll show you in a later chart, right, you start with the commodities, the demand for the commodities, and then the next thing is really two things that affect you, the forex and the transport.
Right.
And so, supply chains and all that, it's very early on in determining what your supply chain is. Your inflation is.
Yep.
Another one is actually on the demand side of inflation. You are seeing that, companies in general are not getting new orders, so they're not spending, so there's less demand. And as I said earlier on, there's a demand pull kind of inflation. The demand is not pulling, so inflation is likely to drop, at least in the next maybe 12 to 18 months.
Right.
So it really depends. Now, earlier on, back to your second question, you can see here, guys, you can pause this very long chart, but essentially why people don't feel it is because of things like your food, airfares, things that you use in your daily life that, you use very often is actually not slowing down as far as inflation is concerned. But remember, you want to try and predict as an investor what is the inflation going forward, not what is the inflation today. Right?
Right.
So that's why you have to look at all these other components before the inflation.
Okay. So I actually noticed that there's the energy, right?
Yeah.
I think it's like rising like 17.6%.
Yeah.
So does that mean that people can start to look at energy stocks? Or
remember, again, these are lagging indicators. So the oil price has already moved, right? And in fact, you wouldn't even need to look at this graph. You just have to look at the graph of oil and gas, natural gas, and all that you have known already. Is it a good investment if you look at oil and gas companies? It really depends on how far you think inflation can extend. Now, I could be wrong, but it seems to me, based on the data, that if you think about it logically, right, all the data I showed forward is showing inflation dropping because it was in a very unique situation. Pandemic led to supply chain congestions, which is, to use a fancy word, transitory. And then some of the revenge spending that you see from the consumer side of things are starting to taper off, right? One chart I didn't put here is the consumer confidence in the US, and that's not doing very well. So on many, many different fronts, right, you can see demand is already shrinking and the supply chain issue is actually reducing. And one thing that is what I call a red herring in this discussion is actually the Ukraine war, the Russia-Ukraine war. A lot of people are saying that the reason that there is inflation is because of the Russia-Ukraine war. without forgetting, right, that when Putin invaded Ukraine, okay, the inflation was something like 7% already. It's crazy.
Yeah.
So really, yes, he had an effect, but he wasn't the cause. There were a lot of these other factors that were affecting.
Inflation was already there way before
Yeah.
when the invasion started.
Of course, certain components like wheat, right, where a big chunk comes from Ukraine, right, it's the breadbasket of Europe.
Yeah.
Yes, for sure.
Yeah.
Definitely he played a role.
Yeah. That one is like putting oil into the fire already.
Yeah. Exactly.
Yeah. Okay.
So that's, now back to your question, right? Like, that's why predicting oil prices can be difficult. But my policy with oil companies is that, look, you want to invest close to the bottom of the cycle.
Yep.
And the question you have to ask yourself is the oil and gas situation right now at the bottom of the cycle, at the middle of the cycle, or at the top of the cycle? And characteristics of companies being at the top of the cycle in general, okay, each company is different, but in general is that profits are very high, at historic highs, or margins are at historic highs. I think margin should be a better one because and yeah, you have to ask yourself that question. If I had to use purely on common sense or what we call the pub test, right? You go to a pub and you test, right? I would say that we are probably in the second half of a oil and gas bull run rather than the first half. Now you then have to further, if let's say you agree with me that we are in the second half of the bull run, then you have to ask yourself, okay, second half can be 51% or 99%. If you're in 51%, then definitely oil and gas stocks are attractive. But if you believe that you're 99%, then obviously they're not. And that's where you need to, learn more and dig out more. No one's going to hand you the answer and say like, oh, this is, you can invest. You need to be like a self-starter to actually go and figure out.
Okay, that's actually pretty interesting.
All right, guys, if you didn't know, we have a one-on-one mentorship program where you can apply for, where we level up your stock investing based on tailor-made solutions. If you're interested, you need to apply. Not all of you all will get into an interview. It's only 20% of you all will do it, and even fewer will get to hop on the program. But if you're confident that you can qualify, you can click on the link and fill in your details in the comment section or the description.
Okay, so speaking of inflation, right? I mean, definitely we also want to know what is the Fed's next move. So would that mean that the Fed will actually start to slow down in the interest rate hike?
It's very hard to say. The big obsession now is inflation. And a lot of it is they probably see themselves similar to Paul Volcker in the 80s. So in the 1970s, you had a very similar situation, except that it's not really a supply chain issue. It was a lot of other factors you guys can go and study. And by many measures, it was a lot worse. People were like queuing up for gas and they couldn't get it. And gas was like skyrocketing. And of course, the people causing the issues back then were OPEC, and OPEC aren't as powerful today as they were back then. And they had a lot of unemployment, right? With, in the 70s. So what will cause the Feds to be less aggressive is a mixture of inflation slowing down. And it's also a mixture of the economy. So what is very ironic is that by focusing on inflation, they have increased interest rates. So when interest rates increase, again, going back to how it affects the economy, people's mortgages will go up. Or the rent, right? Because then now the property owners are like, I'm going to increase your rent because, things like that, right? And guess what? If, unless your wages are growing like mad, people's savings are going to get depleted, right? So if people's savings are going to get depleted, what's going to happen to consumption? It won't collapse, but it will shrink. Right, for that moment at least. Again, affecting demand for inflation. Same with businesses, right? Leveraged businesses will start to go out of order, and then you see consolidation in the industry, right? Because now a lot of players will die. And guess what? Whenever there is a consolidation, these players, what do? They start to dominate.
Raise price and everything.
yeah.
Monopoly lah, or
Correct.
oligopoly. Yeah.
Correct. So anyway, it's always hard to tell, but these are the two big ones, right? And you can see that inflation is dropping and businesses are the leading indicators for the businesses are not doing very well. So the thing about the Fed and why we don't have to behave like the Fed is that the Fed always needs confirmation data. So let's say even if they know, right, that all this that we've talked about, and actually the right thing should be right now to probably reduce rates already, but because they cannot look like stupid.
Yeah.
Imagine, right? Interest rates is at inflation is at 7-8%, right? And then suddenly you start to reduce rate hikes now. Then people are saying, what are you doing? Like, where's the data to support your decisions, right? And the data that is used to support their decisions are coincident or lagging indicators like inflation, like GDP, like unemployment and things like that. So because they cannot just focus on the leading indicators as an investor, you have the opportunity, right? You have the opportunity to essentially front run them, right?
Right. That is actually, if you know what coincident or leading indicator you need to pay attention to, which also we cover a lot in our FIRL Pro program. Okay, so this is actually a pretty interesting stats. The Bank Negara's Q3 data. And if we, so I mean, we just have a chat, right? I mean, notice like Singapore's, the inflation data, right? Majority is actually coming from the housing, utilities, and transport.
Yeah, I mean, people complain in Malaysia because, food is a big part of our lives.
Yes.
Right? And you can see the biggest contributor by nearly half of the 4.5% Q3 data is food related. So, and this one we can feel it, right? Like now, economy rise 10-12 ringgit, easy, right? Desserts, what used to be 20 ringgit, maybe now it's 25 ringgit.
Yeah.
Right? So that's why we feel it really strongly. But if you look at some of the other components like housing, because housing is not something you buy every day, right? So if you look at that, it's really, really small, much more affordable compared to Singapore. What I'm hearing on the ground is that literally within a span of a year, people's public housing, right? This is like HDB flats, right? Is increasing by like 30%. That is mad. Imagine you had to save up for a 800,000 ringgit house. Let's say down payment 80k. Now instead of paying 80k, you have to pay nearly 110k. That is absolutely crazy.
Yeah, in like a span of like few months or even 1 year.
Yeah, that's absolutely mad, right?
Yeah.
And property like lawyer fees and all that is a percentage of the property value. So those are also increasing like mad, right?
Yeah. But actually, one thing that also caught my eye is that in terms of the ASEAN region, right? Malaysia is kind of handling, I wouldn't say handling, but their inflation rate is kind of like lower than Thailand.
Yeah.
So that's actually a pretty interesting thing to see that we're actually kind of doing well, better than Thailand.
Yeah.
Oh, well, but Vietnam in the case also.
Better than everybody except Vietnam.
Yep.
And even Vietnam, we are like quite neck and neck. So.
Yeah. Okay.
So yeah, Malaysia boleh.
Yeah.
So this is why I said earlier on, I have to give like a lot of credit to Bank Negara. I think this is a fantastic chart that, it's more of like flow chart rather.
Yep.
And it shows you like some of the important factors leading into the CPI inflation. Now, what I did not put here is actually that BNM used this to apply to a nasi campur. So like what are the things affecting? So if you look at this, right, if you want to, in a way, like forecast inflation, you have to look at commodity prices. You have to look at international freight, which is related to supply chain, right? Because if it's more congested, freight rates will go up. If it's less congested, freight rates will go down, right? It all affects. How big, it really depends on the industry. And then the exchange rate. So imagine, right now, if you look at what we call the DXY, which is the dollar index, right? It has been on a tear and it's doing better than everybody. If you look at our quarter-on-quarter depreciation, we are about, I think, 4.5%. you think Singapore is great, they are also at like 3.1%. And they have like a semi-peg to the US dollars. For those of you who don't know, the way Singapore like organizes their currency is that they will buy a basket of like international currency. So some yen, some euros, maybe some pounds and some, US dollars. And they change that all the time. They play around with that. And nobody quite knows what is that. So there's like a mini peg in that sense. And yet they still depreciate 3.1%, right? And in my opinion, if you believe inflation is going to taper off, right? In other words, the US dollar right now is actually overvalued, right? Famous last words, but you never know. And so when you factor into this, right? And if exchange rates fall, freight rates are falling, global commodity prices, some falling less than others. Well, what does that mean for the other stuff?
Yep.
Right. So there's going to be huge spillovers into a lot of these other things.
Yeah. Okay. So what I've actually learned is that the leading indicator to actually kind of predict what is the next inflation is going to be is by looking at their commodity prices, the exchange rate, as well as the freight, which is related to the supply chain issue.
Yes.
Okay.
Correct.
All right. Okay. So just to sum up everything, right?
Yeah.
As an investor who is, let's say, they were afraid of investing in this kind of environment, right? They're keeping like 99% cash, right? Is it actually time for them to start to nimble some positions or go all in? I don't know. What are your takes for this?
So you need to realize that investing is about probabilities.
Yeah.
So even though, as you can hear from what I say, you get the impression, rightly so, that I think inflation will start to fall off at least within a year. Right? It might even go to zero inflation, because what I see is that the Federal Reserve is taking advantage, right, of a special unique situation like COVID and supply chain issues, trying to raise interest rates and all that. And then as inflation drops, they can ride off into the sunset and say, hey, look, guys, we conquered inflation. That's why they are doing what we call, that's why they're doing what we call the Volcker, like, rule book. But Paul Volcker was actually solving a much bigger problem, in my view. And that is like unemployment, a lot of inflation, as well as global issues that is outside of his control, such as the wars, which were far more serious than today, and OPEC deliberately trying to mess with the oil prices and spike it up just to attack the US. You guys can read the history, right? But basically, I think that even if the Federal Reserve didn't raise interest rates, inflation will spike and will go down anyways. Maybe they do contribute a little bit to solving inflation. But if you look at all this, if you look back here, right, all of these things is not really in their control, like commodity prices and freight rates. It's not caused by them and they can't fix it also. The only thing that they can do, ironically, right, to fix inflation is to lower the exchange rate. Right?
Yep.
But when you raise interest rates, you are increasing the exchange rates.
Yep.
So you're actually contributing to
inflation
in that sense. So anyway, back to your question. You see, I could be explaining all this, but I could be wrong also. Things can happen. Market is dynamic. It's never the same.
Yep.
So you also have to prepare yourself that the rate hikes will not decrease. Right? Or even if it slows down, it will remain flat. Now, if it remains flat, that means you are more likely to put your money into cash, rightly so, because very few, let's say if it's at 5% interest rates, there are very few stocks out there that's going to do better than 5%.
Yep. Agreed.
So you need to have a balanced approach. And to cut a long story short, I know this is quite a long video already, but you need to actually be a lot more stingy and have much higher standards for investments. And yes, there will be a lot of companies that can do better than 5% every year.
100%. Yeah.
So my suggestion is look hard for these sort of counters. Don't be just all in cash. I'm not all in cash. I think our FIRL Pro portfolio is something like only 60% cash right now, 50% cash.
60%.
And we do intend to reduce it over time. But yeah, those are what I would say. Be stingy.
Okay, thank you MJ for the sharing. Hope you guys enjoyed this video. If you did, make sure you smash the like button, subscribe, all that good stuff. Follow us on our social medias, Instagram, Facebook. All of the links are in the description, and we'll see you in the next video.